Good afternoon, ladies and gentlemen of the board. I am Chelsea Halford, and I'm the CEO of the company, along with Emily Herzog. I am here to talk to you about our company, Champion Footwear. I would like to welcome you to this board meeting and to our company. During this presentation today, I will briefly introduce you to our strategy and our financial performance. I will spend most of my time talking about what we did well on and what we have been working on to improve this company. We have been working hard to learn from our mistakes, and we believe our best days are still ahead of us. We will discuss the reasons why we believe we're on the right path towards the end of the presentation. From the beginning, we put a plan in place to become a leading supplier in the shoe industry and strive to price and market our company's athletic footwear in ways that produce acceptable revenues and profits. We quickly learned that this would be a little challenging in this competitive industry. We tried a differentiation strategy by shoe quality. We were trying to produce a slightly higher quality shoe and strived to have our shoes between 5 to 7 stars in terms of quality. We invested in our workforce by putting a focus on corporate social responsibility and competitive wages. We ended up altering the strategy towards the end because we were spending a lot of money on corporate social responsibility and getting the same results as other companies that spent less money on it. We have room for growth to become one of the leading competitors in this industry. We are taking the necessary steps in order to become the best. We have a total of 9 competitors in our industry. We started in the middle of the market in terms of how the company was doing. We did have a drop in the last few years, and we will go over what contributed to these drops later in the presentation. We made many small mistakes that drove our performance down. We recognize these mistakes and are taking the necessary steps to implement new solutions. We are currently 8th in our market. We have a lot of room for growth and believe that with some tweaking to our strategy, we can gain more market share and become one of the leading companies in the shoe industry. In terms of our performance charts, all of the charts will look similar. The blue line will be our company, Champion Footwear. The red line will represent the industry average for the 9 companies in the industry. This chart shows the revenue for the company benchmarked against the industry average. We were lower than the industry average, but improved the revenue each year except in year 16. We started to figure out our strategy towards the later years, and our revenues started to increase. To get revenue up, we started to put a focus on customer satisfaction and gaining more market share in the later years, and we plan on continuing to work on this. We noticed we were missing a potential market in the private label segment. We had focused on this segment in year 10 and year 13, but slacked off in other years. In year 17, we decided to focus on the private label segment and ended up getting 12.9% of the market, the North American market, and 28.3% of the market in Asia Pacific. In year 16, we see a slight decrease in revenue among the industry, which we contributed to the adverse exchange rates. As you can tell by this graph, our stock price was lower than the industry average as well. One of the biggest things we did not do was issue out more common stock. This was an overlook by us. In year 10, we had 10,000 outstanding shares, and last year we ended up the year with 10,000 shares. We also were not consistent on the dividend we issued out. One year we would issue one around 30 cents a share, and another year we would not issue one at all. This did not signal optimism about the future to the shareholders. We decided to issue a dividend in year 14, which helped increase our stock price. We went back and forth between having a dividend and not having a dividend, and this did not help our stock price. When we did offer a dividend, it was significantly below the industry average, and this hurt our stock price. We plan to offer a dividend in the next few years since we are optimistic about the future. The plan for year 18 is to reintroduce our dividend at 50 cents a share. We also did not buy back any of the common stock which we had outstanding, which we believe could be an advantage to look at in the future. If we are able to buy back stock in the future, we will see the number of outstanding shares in the market reduced. The relative ownership stake of each investor will increase because of the fewer shares of the earning of the company. When there are fewer shares in the market, the stock price will go up. This graph shows our profits compared to the industry average. We were below industry average every year. One of the major contributions to our profits being low is our high cost per pair of shoes. Our cost per shoe was high compared to the industry. We needed to make changes to lower our cost per shoe, and we plan on doing that in the years to come. The company was investing a lot in training, Six Sigma, and wage increases, which was increasing our shoe manufacturing cost. We decided to cut back on these costs in order to drive the cost of the shoe down. We have been coming up with a strategy to get our cost per shoe lower than competitors. By doing this, we feel we will become more competitive and make more profits.
Although we have not made any huge mistakes, we have made several small mistakes that have hurt our performance. The first mistake we made was producing two different qualities of shoes. This made things much more complicated than it needed to be. We are producing a 7-star shoe in our North America plant and a 5-star shoe in our Asia Pacific plant. In order to run efficiently, we needed to consider two different strategies for both plants. Another mistake we made was not realizing the importance of the number of models offered. Originally, we thought that the SQ rating was going to be the most valuable thing to the customer and centered our strategy around that. However, we quickly figured out that this wasn't the case. We noticed that the companies that had the most market share offered higher numbers of models. The biggest thing that cost us in our performance was our cost per shoe was way too high. We were spending too much on labor and corporate responsibility spending. We thought that this heavy investment in corporate responsibility would help us out and give us an advantage over other companies. The last thing that we did not do well was we did not fully utilize our plant upgrades. We opted for option C in our North America plant, which boosted our SQ rating by 1 star. Instead of cutting our costs and producing the same quality of shoe, we kept our costs the same and increased the quality of shoe, making things much more complicated. In our Asia Pacific plant, we opted for upgrade B, which offers a discount on the number of models offered. And even though we opted for this upgrade, we did not increase the number of models offered in our Asia Pacific plant like we should have. And as you can see, here's a graph of our cost per shoe sold in our branded North America plant. And the whole 7 years we are above the industry average. But towards the end we noticed our overspending and started to cut back, and you can see at year 17 that we're starting to close this gap. So now that I've talked about some of the mistakes we've made, I'd like to talk about the things that we did well. We had a really low reject rate throughout the whole 7 years. In fact, most of the years, our reject rate was actually the lowest out of all the companies. And we did this by utilizing upgrade A in both plants, which cuts the reject rate in half. And we spent heavily on TQM and Six Sigma training in both plants. We also spent a lot on corporate social responsibility. In year 14, we won second place for the Corporate Responsibility Award and went on to win first place in year 15. However, we soon discovered that we were overspending. We found out that there were other companies spending much less than we were, but achieving the same results. And here's a graph of our reject rate. You can see after year 13, our rate plummets all the way from around 7.5 to 3.5, and we stay well below the industry average for the rest of the years. So now that we've talked about our performance and our strengths and weaknesses, let's talk about where we're going from here. Our first step is that we're going to analyze top competitors to see where the market is heading. We think that by analyzing the price, the advertising, the SQ rating and the number of models offered of our top competitors, we can see what's in our best interest to do going forward. We are going to simplify production and align our two plants and produce only 5-star shoes. And this will greatly decrease our costs in our North America plant. And going forward, we want to put more emphasis on the number of models offered instead of a higher SQ rating. And by doing this, we're going to utilize upgrade C in North America and upgrade B in Asia Pacific. So here's an analysis of our top competitors, which were the D company, the G company, and the E company. And I've compiled the price of their shoes, the SQ rating of their shoes, the number of models offered, and the advertising budget for each of these companies for the past 3 years. So our plan going forward is going to be a price of around $68, and that's based off of the E company's shoes because that's the company with the most similar strategy to ours. Their SQ rating is 5, which is what we want to produce, and so we're going to pay more attention to their price than the other two competitors because their SQ rating was higher. And the average of the number of models offered was 408 of these 3 companies, which tells us that we greatly need to increase the number of models we offer, and so we think we need to offer at least 400 from year 18 on. And the average advertising budget is around $5 million, so we need to up our advertising budget and probably spend around that same amount. That concludes our presentation. Thank you for listening.